But for the rest of us that are just also blue pot investors, we didn't sell silver or gold throughout this coming down. In terms of unleveraged to the target that was suggesting a 4,300, we were aware the small pattern is breaking us out of the larger pattern, the falling wedge. A bit of a heartache for precious metals fans, especially the silver guys. Lots of selling coming off. Of course, Hormuz, the oil started to take precedence over precious metals. Last 50s, you would say 54 probably on silver was your localized low. I want to warn that there's a real debt-based potential crisis. I think you might want to talk more about that. And most of this precious metals move is central banks and institutions. It's not excessive retail participation. That was happening here near the highs. Sadly, retail are like dogs that chase cars. They really want momentum. I think we're going to finish in the larger range between the previous high, 121, and the low of 55. I would say that's your 60% probability.
Quite an exciting day as we're seeing a pop again in gold and silver. Gold trading above 4,400 and silver trading above 66 here. Your take on the recent price action and breakout in the metals?
Yes, it's been great, hasn't it? Well, the continuation pattern, there was a falling wedge, best shown, I suppose, with a chart, so I should jump straight in, has broken, as suggested it would after 3 impulses. Let's have a look at it on the weekly time frame. This is gold, and we have annotated for this before. I think we've been showing this here a couple of times that we've been on with you, that, we went into the end of Jan very strong. We had a little bit of a warning with a blow-off volatility to 5.6, but pretty much you were trending all the way along here from our end of August, September break, which is the same time now. So it's kind of ironic, just a little seasonality point to plant as a seed here. Tail end of August, here we were, and we call for that breakout. So we were once, twice, 3 times a lady at 2K, saying it was going to 3K at around the 3K level. Again, August, going and break, run all the way up, 5.6, the absolute high. Trended into this point, then we sold off. That was first impulse.
Gold breaking higher is not the story. The real signal is that a months-long pattern has finally failed. As Francis Hunt points out here, the falling wedge broke after 3 impulses, with the timing near late August echoing the previous major advance. That timing matters because technical breaks can attract institutional money. For investors, dismissing this as another bounce could mean missing a larger trend shift. Next, Francis Hunt exposes why positioning could matter more than price.
Second impulse was a long, bloated one, a bit of a heartache for precious metals fans, especially the silver guys. Lots of selling coming off. Of course, Hormuz, the oil started to take precedence over precious metals. A lot of surplus nations were rolling their excesses of net imports by America into gold. So the deficits that the US was running was leaning to the gold run. So hence the war actually got those surplus trade nations focusing on their energies. All of them are energy importers. So they then had to focus on oil and depth of inventory on energies. And that ended up being a long, bloated second impulse into the lows. But what you can see technically, a little bit of a buying up wick on that hammer. It started again, another hammer, and then another hammer over here. We thought we would be up and running. And then there was a little wobble, and then we kind of got frozen in just up north side of the 4K level, and a week before last, we were saying we think midweek, the following week, we'll be breaking out. We had a beautiful little, on a much smaller time frame now, there's that 4,000 mark. You had the upside HVF structure, which is what we focus on. It's very light, very, very good breakout pattern. I can't recommend it enough. And of course here, instead of just trading the pattern.
The biggest clue may be what drove gold toward its lows, not the breakout that followed. According to Francis Hunt, surplus nations redirected capital toward energy after war, disrupted their priorities, creating a prolonged second impulse before repeated hammer formations appeared. That reframes the correction as positioning rather than simple investor fear. For metals holders, understanding who is reallocating capital matters more than reacting to each headline. Next, Francis Hunt unravels why the $4,000 breakout could signal institutional positioning.
To the target that was suggesting a 4,300, we were aware that the small pattern is breaking us out of the larger pattern, the falling wedge. And the first in a new trend always has overperformance, so we stay long. You might just about make out that there's a channel in here. We call this an overperformance trumpet, and it particularly applies on first setups in new trends. So you keep long technically until such time as you either fall out the lower part of the trumpet channel, or if you break out the top, we wait until you return and cross back in. So we close there. So if you're going to hyper-perform and break out, we only close on the return into the channel. So that's the methodology, a little bit of what we do in terms of trading the gold market. It's been absolutely fabulous for us. And I just, for authenticity's sake, we really do play in the markets. These are entries here on one platform that we've carried over. I have closed those now. They were all around 4043, 51 and 53, different platforms as well. We trade this all the way across, and it's been a very, very profitable entry for us, as you can see, across different platforms. So I'm hoping those that do a little bit of trading, I hope you know what you do, first of all, non-advisory, have also enjoyed it.
The breakout matters less than the discipline behind it, because chasing strength is how investors surrender their edge. What Francis Hunt's argument suggests is that the smaller HVF pattern did not merely hit its target, it escaped from a larger falling wedge, creating potential overperformance in a new trend. That changes how exits should be judged. Investors should watch trend structure, not emotion. Next, Francis Hunt exposes the precise signal that could invalidate this bullish momentum.
But for the rest of us that are just also blue pot investors, and we didn't sell silver or gold throughout this coming down. In terms of unleveraged, we don't sell, we're net accumulators, because the big game hasn't yet happened, the grand reset of debt and fiat, although I think you might be taking us into those weeds when we talk about recent events with Besant and the JPY. But yeah, that's, I suppose, my opening salvo on a very pleasant and a profitable period for us.
I would like to get into the recent manipulation in the yen market, but I did want to first get into what is happening in silver. It seems like maybe silver has a pretty clear breakout as well, as it's trading around 66, about $11 above its low now. Do you think we've hit the low in metals here, and what are you looking at specifically in silver?
So for us, this 50s, you would say 54 probably on silver was your localized low, and those 39.54s on gold were a localized low for us. There's just one. There's some people that have gone completely, I hesitate to say, a little bit too crypto for me in terms of predictions and timings on precious metals. I want to warn that there's a real debt-based potential crisis. I think you might want to talk more about that.
Gold's breakout is encouraging, but the bigger danger is believing every rally becomes a straight line higher. This is where Francis Hunt's thesis shifts. Unleveraged investors can accumulate through volatility, while traders manage defined technical exits, because a debt crisis could force even institutions to liquidate metals. That distinction matters for portfolios built around preservation. Next, Francis Hunt reveals why the localized bottom still carries a dangerous escape clause.
So I'll not say too much on that, but that's a wild card that can see everything get sold in margin by the same institutions that are currently metals buyers, by the way. And most of this precious metals move as central banks and institutions. It's not excessive retail participation. That was happening here near the highs. Sadly, retail are like dogs that chase cars. They really want momentum. They don't know what to do if the car's stationary. We're not. The retail engagement here is far lower, I would imagine, than the retail engagement was over there as a percentage. And even still, the price makers are the institutions and the central banks and the nation states, I suppose. China would be probably qualify as a price maker and chaser at the moment. So, yeah, I'm not sure I answered your question. I hope I did.
It sounds like there could be a possibility of another spike low if we do see a sell everything event. But I guess on a technical basis right now, are you bullish on silver? Do you think this breakout will continue?
Yeah, so I will come back. Sorry, I get the gist of the question again. What we're actually saying is we feel that's a localized bottom. We leave a door open for an exceptional event that could lead to, and it's the kind that would be a headline event.
A rising gold price can hide a fragile monetary system, and that distinction changes how investors should read the rally. Francis Hunt notes that central banks and institutions, rather than retail traders, remain the dominant force in precious metals, while a debt shock could trigger forced selling. That means today's strength is not automatically safe haven certainty. Investors should distinguish institutional demand from emergency liquidation. Next, Francis Hunt exposes why institutional ownership can become a source of volatility.
Subprime, the spill from $1,003 down to $698. CV19, you had silver fall to I think it was 11 or 14. I can't quite remember at the absolute low. Technically, I don't think you could buy it at that level. You might get that. But outside of that, let's say 10%, 15% possibility, we feel this is a localized low. But we also, following on from that, we don't want to just go, you're just going to go ripping. This doesn't have unbelievable volume, and there has been some pushback at the end in both wicks so far. You can tell by the weightiness, the degree of volume. This is a good working off a low move. To put you into mid-range. It's not escape velocity for new highs before Christmas, I don't feel. I think we're going to finish in the larger range between the previous high, 121, and, the low of 55. I would say that's your 60% probability. The chance you go beyond, maybe 25% on the high side and maybe 15% on the downside for the remainder of the year. So for people that are just asking where we're going to be come Christmas or mid-December, the markets usually slow down a little bit. They can sometimes move a touch. I would say in range, which is the previous high and this as localized low. I would give you my 60% number in there, Elijah.
Silver's rebound is encouraging, but the absence of escape velocity may be the most important detail investors miss. According to Francis Hunt, limited volume and persistent upper wicks suggest a recovery from the lows rather than confirmation of an immediate return to record highs. His 60% base case keeps silver inside a broad range through year-end. For investors, that argues against chasing every spike. Next, Francis Hunt exposes what could violently break that range.
In terms of silver, which can be quite good. You can be at 82, you could be at 77. I think it's generally going to drift and be more buoyant than heavy outside of that wild card regarding debt and a major demand-destroying event, which is building, it has to be said.
Right now, we're offering silver Morgan or Peace dollars in a call grade at one of the lowest premiums we've ever seen. Call us at 1-888-815-4237 for details on this rare, low-premium opportunity to stack one of the most sought-after coins in the U.S.
It seems like things are building, and I wanted to ask you what you're looking at right now. I know a major event recently was the U.S. Treasury intervening in the yen trade to prop up the value of the yen, and it's so funny because we had Andy Schekman on yesterday, and we were we're talking about how the U.S. dollar and the Treasury market is seen as it's the most liquid market. There's so much demand for it, but as soon as Japan considers selling some treasuries, we have to run to the rescue over there and make sure they don't do that. So your take on that whole situation and any other signposts or triggers you could see for a potential demand destroying event, as you say.
Japan's Treasury dilemma exposes a contradiction Wall Street rarely emphasizes. A supposedly liquid market may need official support when holders want to sell. What Francis Hunt is highlighting is that alternative funding can be offered, because outright selling could destabilize prices, effectively protecting the market from its own sellers. For investors, that raises questions about whether liquidity is genuinely deep or simply engineered. Next, Francis Hunt reveals why Japan's exit can become America's crisis.
Yeah, Andy's bang on the money as usual, and he's absolutely right to make that observation. In fact, we've done a whole Substack post on this very concept. It's called the fallacy of market cap. Technically, from 1 year to 30 year, so excluding durations below than a year, there's a 24 plus trillion market cap of US debt out there. However, the liquidity at the price that they're attempting to retain is surprisingly low. And there's an asymmetry. Price discovery mechanism is when sellers are as welcome as buyers. And we've coined the phrase, when you're a big holder of USTs, it's almost like the Hotel California. You can check out anytime you like, but you can never leave. And that is very much the feeling here. So there's not just the example of Japan being volunteered to utilize a repo system. Hey, we gave you 1.2 trillion. How about you just let us get out and get our 1.2 trillion back, or whatever we can salvage that the market will allow. No. We don't want you doing that. Why don't you take a loan? It's very expeditious in terms of that. And that's why the phony narrative of the US coming to help a friend. No, it isn't. A problem for Japan that holds your asset becomes your problem if they're going to try sell it. And you then have to give them alternatives to access capital.
The Treasury market's enormous size creates an illusion of liquidity that could become dangerous when major holders actually try to exit. Francis Hunt's argument suggests more than $24 trillion of US debt exists across 1 to 30-year maturities, yet the market may not absorb large sellers without severe price disruption. For savers, that means safe assets can carry hidden exit risk. Next, Francis Hunt exposes why Japan's treasury problem becomes America's problem.
That's an explainer. And it's kind of a softer version of BlackRock and Blackstone's closing down the private credit market. Again, we'll come to that one later, I'm sure. But it is a sort of a soft version. And I want to highlight it's not the only example. Swap lines were rushed out for the GCC states, the Gulf states, during the loss of tourist revenue, during the loss of oil revenue following bombings and the Straits of Hormuz attack vector. And they too sit with a peg for the Riyadh against the USD, and they were not having tourists, not having attendees. People were selling apartments once they realized there's 2 weeks of food and water there, and then everything else needs importing in. And they were selling, getting their Riyadh and wanting to turn it into dollars and leave. That's not very helpful for a peg, which has to be held up. So the Saudis wanted to sell USTs, and it was like, no, swap line time. And then, of course, there was the California Teachers Fund, which I recall and remember a couple more years back. Many people won't know, but one of the largest statist pension funds couldn't make a payroll, and they wanted to sell treasuries. And very quickly, the US jumped out and said, no, we're writing new clauses in to our mandate. You're entitled to take a loan against the T's.
When governments discourage selling, the problem becomes who controls price discovery. According to Francis Hunt, swap lines and emergency funding have repeatedly appeared when foreign holders needed liquidity, effectively replacing market exits with borrowing that can protect short-term stability while transferring risk elsewhere. For wealth preservation, that distinction is enormous because an asset can remain quoted while becoming harder to liquidate. Next, Francis Hunt unravels the broader pattern behind these supposedly temporary interventions.
So this is not a single event. This is a line item. It's very much once the hand has gone through the hole, it doesn't come back out. And that doesn't point to true market price discovery. This points to Ponzi establishment. I joke that there was a micro crypto formed called Hex, where all the buyers were encouraged to bring their friends and buy the token, and they were all encouraged also to stake it, so that for 15 years with huge penalties if you unstaked it, with compounded 39% plus reward, 5,555 days, which is the better part of 15 years. So you essentially get buyers in, and then you ensure they never do any downside damage to the market cap. And they successfully ran that market cap on that token to 77 billion, which is now 99.9% down. And that was the founder knew and understood the concept of market cap, and even was quite open about explaining it to those that participated. You see, it's worth a lot if none of us sell. Well, yes, but every now and then you have to get out, and that means selling. And so I think we actually have the micro crypto event in a much larger scale in terms of USTs. And this is incredibly bullish gold. It's not very bullish the future of Western economies.
A market can look enormous on paper while becoming fragile the moment owners actually demand cash. Francis Hunt notes that the recurring pattern of emergency funding resembles a larger version of locked-up speculative markets, where valuations survive, partly because selling is discouraged. That undermines the idea that quoted prices automatically equal real liquidity. For investors, the danger is mistaking capitalization for exit capacity. Next, Francis Hunt exposes why this hidden fragility could ultimately strengthen gold.
And the crash that goes it. And we must be careful about being excessively gleeful about our gold bags going up, because it's actually not our gold bags going up. This is still the same, silver ounces that it's always been. It's a story of a debt-based fiat collapse, which is how we've started so many of our presentations with you. You are in a debt-based fiat collapse. The yen is going down and the rates are going up. Milkshake theorists have often said, the US rates will go up and then the dollar will appreciate because money will all be coming for that better yield. No, that's not how it's transpiring. Debt and fiat are very similar things. Fiat is money today. Debt is, hey, have it in a year's time and I'll pay you a rental agreement for a year. That's it. Otherwise, they're the same thing. You can't kill debt without, in the longer term, killing fiat. They can diverge for short periods, but on the long haul, no. And you're seeing if the Japanese sell their treasuries and then repatriate their money, which is a little bit of an inverse carry trade, a reversal on the carry trade, you saw how damaging it was to the 10-year, the 30-year, and how quickly it became America's problem, and they were there to help Japan with other facilities. Well, why not just give them the money back? Why not let them to sell it? Well, we don't want that because the market can't take it, Elijah.
Gold's strength becomes more unsettling when it reflects weakness in the currency system beneath it. This is where Francis Hunt's thesis shifts toward debt and fiat, arguing that rising rates do not automatically strengthen the dollar when debt burdens become the dominant force. That matters because Treasury stress can migrate rapidly into broader markets.